Every year, you go to work, you work hard, and before you ever see your paycheck, they already took their cut. Federal income tax, state income tax, Social Security, Medicare, gone before the money ever hits your account. Now, here's what I need you to understand. The wealthiest 400 families in America paid an average tax rate of 8.2%. The average American worker paid 13% on less money. You paid a higher rate on less money. That is not a glitch, that is the design. Get the money, MC, Baltimore. Today I'm gonna show you how the game is rigged, and more importantly, the legal moves inside that same tax code that regular people almost never use. The tax code in America is 70,000 pages long. You know who wrote most of it? Lobbyists for wealthy people and corporations. Not conspiracy, not speculation, documented fact. The tax code is the result of decades of legislation shaped by people with accountants, lawyers, and the financial resources to influence the rules. And the rules they shape reward one thing above everything else: owning assets instead of working for income. Here's the most important sentence in this episode. The tax code taxes work at a higher rate than it taxes wealth. A nurse earning $80,000 a year pays federal income tax at 22% on most of her income. An investor earning $80,000 from stocks held more than 1 year pays 15%, or in some cases, zero. Same dollar amount, different tax rates, because one person worked for it and one person owned something. The top income tax rate on wages is 37%. The top tax rate on long-term capital gains, profits from owning assets, is 20%. Work taxed at 37%, ownership taxed at 20%. That gap is not an accident, and it gets worse. The payroll tax, Social Security, is 6.2% of your wages. You pay it on every dollar you earn up to 17.6. 120, 25 above that, nothing. So a worker earning $60,000 pays 6.2% on all of it. A billionaire earning $10 million in wages pays 6.2% on the first 17.6, effectively a rate of 1.1% on their total income. The tax that funds retirement security for working Americans hits hardest the people who can least afford it.
I want to walk you through something. It's called buy, borrow, die. It is completely legal. And it is how the ultra-wealthy pay almost nothing in taxes over their entire lives. Step 1, buy. You purchase assets that grow in value: stocks, real estate, a business. You hold them. You never sell them. As they grow in value, your wealth grows. But because you haven't sold anything, you haven't realized the gain. Under current tax law, unrealized gains are not taxed. Jeff Bezos owns approximately 10% of Amazon. As Amazon's value grows, his wealth grows by billions. He owes zero in capital gains tax because he hasn't sold a share. Step 2, borrow. Instead of selling assets and paying capital gains tax, you borrow against them. Ace 10 million stock portfolio can secure a loan of $5 to $9 million. That loan is not income. It is not taxed. You use that cash to fund your entire lifestyle: homes, vacations, investments, and other assets. All of it paid for with borrowed money that never gets reported as taxable income. Some of the wealthiest people in America have taken this so far that they've paid zero federal income taxes in certain years. Not because they were broke, because loans are not income. Step 3, die. When you die, your heirs inherit your assets at a stepped-up basis. Here's what that means. You bought stock for $1 million. Over 30 years, it grew to $10 million. If you sold it during your lifetime, you pay capital gains tax on the $9 million profit. But if you hold it until death, your heirs inherit it valued at $10 million, the current market price. They sell it the next day. The profit is calculated from $10 million to $10 million, zero capital gains. The entire $9 million of growth that happened during your lifetime escapes taxation forever. The loan gets paid off from the estate. The rest goes to the family. A lifetime of appreciation, never taxed, not once. This strategy is not available to most regular people. You need millions in appreciating assets to borrow against. You need access to low-interest loans that most banks don't offer to working-class borrowers. It was designed by and for people who already have enormous wealth. But understanding, it tells you exactly how the game works and why the people at the top pay less than the people at the bottom.
Now, here's what you should really know. The same tax code that was written by lobbyists for the wealthy, that same document contains tools that regular working people qualify for and almost never use. Not because they don't exist, because nobody explained them. The IRS will not add credits you didn't claim. They keep the money. You have to know about it. You have to claim it yourself. What I'm about to show you is money that is legally yours. Money the tax code says you are entitled to. Money that millions of eligible people leave on the table every single year because they didn't know it existed. That ends today. Nearly 1 in 5 eligible Americans never claims the Earned Income Tax Credit. 1 in 5. The Earned Income Tax Credit is a refundable tax credit for working families and individuals with moderate incomes. Refundable means even if you owe zero in taxes, you can receive the full amount as a cash refund. This is not a deduction. This is not a discount on what you owe. This is the government writing you a check. The average EITC for a family with children was $3,000 in 2024. The maximum for a family with 3 or more children in 2025 is $8,000 that the government owes you, that you have to claim yourself. Who qualifies? Families earning below $70,000, married filing jointly with 3 or more children. Single filers with 1 child earning under $50,000. Even workers without children may qualify if their income is low enough. In 2023, 23.5 million working families collected it. Roughly 1 in 5 who should have didn't. Why do people miss it? They assume they don't qualify. They find it complicated. Nobody told them it existed. Go to irs.gov, search EITC, Assistant, 5 minutes. Find out if you qualify. This is the most important 5 minutes you will spend on your taxes this year.
Most people know the traditional retirement plan from work is meant to help you later in life. What many people do not realize is that it can also lower the amount of tax you owe right now. When you put money into a traditional workplace retirement plan, that money is removed from the income. The government uses to calculate your taxes. In simple terms, the more you contribute, the less of your income is counted as taxable for the current year. Imagine earning a certain salary and choosing to place part of it into the retirement plan. The government will only tax the remaining portion, not the part you contributed. That means you keep more money in your pocket today while also saving for your future at the same time. If you are in a typical middle income tax bracket, a contribution can reduce your tax bill by a meaningful amount immediately. You are not waiting decades to see the benefit. The advantage starts in the same year you contribute. Many workers only contribute enough to receive the employer match and then stop. But by doing so, they often miss the chance to lower their taxes even further while increasing the amount invested for retirement. The contribution limits allow workers to set aside a significant portion of their income each year. Older workers are allowed to contribute even more through special catch-up rules designed to help them prepare for retirement more quickly. Every dollar placed into this type of retirement account is a dollar that is not taxed today. It is one of the few financial moves that can both reduce your current tax burden and build long-term wealth at the same time.
one account in the entire United States tax code with 3 tax advantages simultaneously. Not 2, 3. The Health Savings Account, the HSA. First advantage, contributions are pre-tax. Every dollar you put in reduces your taxable income this year, just like the 401k. Second advantage, the money grows completely tax-free. Invested in index funds, watch it compound, owe nothing on the growth. Third advantage, when you take money out for qualified medical expenses, doctor visits, prescriptions, dental, vision, it comes out tax-free. Pre-tax and tax-free growth, tax-free out, that combination does not exist anywhere else in the tax code. And here's the part most people never hear. After age 65, you can withdraw from an HSA for any reason at all, not just medical. At that point, it works exactly like a traditional IRA. You simply pay ordinary income tax on non-medical withdrawals. So the HSA is secretly a second retirement account for anyone who doesn't touch it. The current contribution limit is $4,300 for individuals, $18,550 for families. You need a qualifying high deductible health plan. If you have one and you are not maxing the HSA, you are leaving the most tax advantaged account in America sitting empty. Here is something that most financial channels never talk about. There is a 0% capital gains tax rate. 0. Nothing owed to the IRS on your investment profits. Here's how it works. Long-term capital gains, profits from investments you held more than 1 year, are taxed at 0%, 15%, or 20% depending on your total taxable income. Currently, if your total taxable income is below $50,000 as a single filer or below $97,000 as a married couple filing jointly, your long-term capital gains tax rate is 0. A couple with $70,000 in combined income sells $20,000 worth of stocks held more than a year. On those $20,000 in investment profits, they may owe nothing. 0. This means middle-income investors who time their investment sales carefully and keep their taxable income below the threshold can realize substantial investment gains in a given year and pay no federal capital gains tax at all. This is legal. This is in the tax code. Most people who qualify for it have never heard of it.
Yo, the Money MC. Here comes the full playbook. Check if you qualify for income-based tax credits. Visit IRS website and use the eligibility tool for the Earned Income Tax Credit. Many people qualify but never claim it. Even though it can provide a significant refund, it is refundable, which means you may still receive money, even if you owe little or no tax. Claim available tax credits related to children and childcare. Families with qualifying children may receive valuable tax credits that directly reduce the amount of tax owed. If you paid for childcare so you could work, there is also a credit that can return part of those costs. These are not deductions. They reduce your tax bill directly. Contribute as much as possible to your workplace retirement plan. Money placed into a traditional employer retirement account reduces your taxable income immediately while helping you build retirement savings. At the very least, contribute enough to receive the full employer match, since that is essentially free money. Use a health savings account if you are eligible. If your health insurance qualifies, a health savings account provides exceptional tax advantages, contributions, reduce taxable income. The investments grow without tax, and withdrawals for medical expenses are tax-free over time. This account can become a powerful long-term savings tool. Open and regularly contribute to a Roth retirement account. A Roth account is funded with money that has already been taxed, but the growth can be withdrawn tax-free in the future. This can be especially beneficial if you expect your tax rate to be higher later in life. Consistent contributions and long-term investing can create completely tax-free retirement income. Understand how investment taxes work. Your income level affects how much tax you pay on long-term investment gains. Planning when to sell investment can sometimes reduce or even eliminate tax taxes on those gains. Use investment losses strategically. If some investments decline in value, selling them may allow you to reduce taxes on gains from other investments, or even lower taxable income. Reviewing your portfolio regularly helps you take advantage of this strategy. Use reliable tax preparation, help a qualified tax professional or comprehensive tax software can identify credits and deductions you may not know about. Many people miss valuable tax benefits simply because they do not realize they qualify. Good guidance often pays for itself through the savings it uncovers. Together, these steps show that understanding the tax system can help you legally keep more of your money while strengthening your financial future. Yo, the Money MC. I want to be clear about something. The goal of telling these is not to make you angry at wealthy people. The goal is to make you informed about the rules of a game you are already playing, whether you know it or not. The tax code is not neutral. It was not written with you in mind, but buried inside it are tools that the same lawmakers who wrote the advantages for the wealthy also left for regular workers, because politically they had to. The EITC, the child tax credit, the HSA, the 401 deduction, the Roth IRA, the 0% capital gains rate. These are not loopholes, these are features that regular people qualify for and almost never use. The wealthy have accountants and lawyers whose entire job is to find every advantage in the tax code. Most working families do their taxes in one sitting with the form their employer sent them. That imbalance in knowledge, in access, in time is part of how the gap widens every year. You just close that gap. You know how the game works now. Use what you learn. Yo, the Money MC, Baltimore. The tax game is rigged at the top, but there are tools in that same code that belong to you. Claim them. Subscribe to the Money MC, Washington, D.C. Share this with someone who needed to hear it. Stay smart, stay solid, stay free. We out. We out.